Hello everyone. I welcome all of you on behalf of iACT to the very first session of risk management. Let me first congratulate all of you on taking this step towards the learning and understanding of risk management because, trust me, not many people do that. They do not invest in themselves. So before we get started, let's set some ground rules for all the upcoming sessions. Have pen and paper with you and take notes because we are going to cover wonderful content in all our respective sessions. Remove all your distractions and focus because focus is the key to success. And open your mind for new learning and knowledge because learning is like a line with no ends to it. So let's start it and see what you are going to learn today as per the agenda. So firstly, I'll take you through the risk management course content. Then we will cover the risk identification, analysis and management, wherein we learn about the nature and the sources of risk, types of risk, which is business risk and non-business risk, the benefits of risk management, and the steps in risk management process. At the end, we will do the recap and then we are going to have Q&A session. Now, come to the course coverage. So we can bifurcate the total course in four major sections, which includes first is risk identification, analysis and management, which we are gonna cover today itself. Then we will talk about risk types, wherein you will gain in-depth knowledge of each type of risk, which is market risk, operational risk, liquidity risk, credit risk, and currency risk. After that, you will see that what type of risk prevails in different sectors and how these risks impact these sectors. So in the third section, we have risk management in various sectors like banking, insurance, and service sector companies. In the last section, you will gain knowledge about the derivatives, in which we have credit derivatives. So a financial institution or bank generally transfer their credit risk, which is associated with a loan or portfolio, using credit derivatives. And you will surely gain detailed understanding when we will cover this topic. And then we have commodity derivative for risk management, which is related to commodities like agriculture products, oil, gas, electricity, and precious metals that can be traded in an organized market. I know you all have found this very interesting. So, let's move on. What is risk, risk-return trade-off, and nature of risk? Risk and return go hand by hand, and there is a reciprocal relationship between risk and return. There is a well-known saying or a journal saying that higher the risk, higher the return. So, the pursuit of higher return by business firms implies that they have to deal with higher level of risk also. For example, as we know that when we do investment in debt, then we're going to receive the fixed amount of interest rate, interest on it, and the risk is also, so the risk is less, and in that case, the return is also less. However, on the other hand, when we do investment in equity, then we take higher risk with an expectation to have higher return. So, there is a reciprocal relationship between risk and return. Before I move to the formal definition of risk, it's generally found that people get misunderstood with the concept of that how is risk different from uncertainty. So let's understand that risk is how different from uncertainty. Risk is measurable uncertainty and uncertainty is unmeasurable risk. So from this, we can say that risk is measurable, and it is certain. Because if risk cannot be measured, then it is not risk, it is uncertainty. Now, come to the formal definition of risk. So, risk is the possibility of actual outcome varying from the expected outcome. So, when we say outcome, that means we can measure something out of it. And when we say actual outcome, that means there is some certainty with which we are comparing the actual outcome. So, the variation between the actual outcome and the expected outcome leads to give us risk. After understanding that what is risk and the difference between risk and uncertainty, now we are moving to the sources of risk, that how the risk comes into the picture. What are the factors which brings risk? So, the factors which brings risk are economic factors, such as the economic policies of the government, change in money supply, level of taxes, inflation, exchange rates, and interest rates. And all these factors influence the actual return. Then we have market factors, such as prices, competitive conditions, market shares, and consumer preferences. The technological factors, as the name itself says, is when there is a change in production technology or development of new and improved products. There are also financial factors which brings risk to the business, such as the cost structure and the capital structure of a firm. So a firm that has a larger share of fixed cost, or we can say debt instruments in its cost structure or the capital structure, then the larger share of debt in its capital structure faces a high amount of risk. Because we all know that interest is a mandate payment as compared to the dividend, which is based on profit. So higher debt content leads to higher risk to the company, that they have to pay the interest to the debt holders even if it is not earning profit. Then we have human factors, which is the conflict between when personal and professional interest of the employees comes into the picture. And this gives operational risk to the organization. At last, there are natural factors also, such as floods and earthquakes. So now we know that what are the various factors and the sources from which risk comes into the picture. So now understand that what are the different types of risk. The risk can be bifurcated or broadly can be classified as business risk and non-business risk, in which the business risk is the part of business activity. That means the risk which is inherited in business and the risk with which when started, so that is very much implied, because it is related to the product and service marketing which firms operate, and this is due to technology, competitive, and consumer preferences. So these are the risks that firmly willingly assume as a part of its business activity. Then we have non-business risks. These are the risks over which firms have no control. They include strategic risk and financial risk, wherein strategic risk is the result from the fundamental shift in the economy and the political environment. Like nationalization is one of the best example of strategic risk. Now, financial risk. So financial risk is related to possible losses in the financial market, such as loss due to the change in interest rate or default on the financial obligation by the counterparty, which leads to credit risk. So financial risk is a very interesting risk to understand, and this can be divided into market risk, credit risk, and operational risk. Also, there is another source of financial risk, which is liquidity risk. And in the next slide onwards, we will understand all these risks. As I have just mentioned, that financial risk can be divided or further classified into market risk, liquidity risk, credit risk, and operational risk. So I will give you here just a flavor of each type of risk, because we have full coverage of each and every type of risk in our subsequent sessions. So let's now understand in brief what is market risk. So market risk is the risks which arise due to the movement in financial variables such as security markets, or you can say security prices in the security market, interest rates, foreign exchange rates, and commodity prices. So the risk that is because of the fluctuation in the portfolio value due to the changes in these variables leads to give the market risk. Or we can also say when these financial variables adversely affect the value of on and off the balance sheet positions, then that gives rise to market risk. So market risk can be further classified into price risk, currency risk, interest rate risk, and commodity risk, wherein price risk arises due to the unfavorable movement in the prices of the security and other obligations. So price risk is a very important for an investment institution or bank. The further bifurcation is also available for the price risk, which is like symmetrical and non-symmetrical risk. So when a firm holds a portfolio of equity shares, an increase or decrease in the price of equity share by an equal amount will have an equal corresponding change in the value of portfolio. And this is then an example of symmetrical price risk. However, if a firm holds a portfolio of options, say put option, where they have right to sell, then a fall in the prices of underlying security will result in a corresponding increase in the value of portfolio. And on the other hand, an equal increase in the price of security beyond the strike price does not decrease the value of the portfolio by an equal amount. So then this is an example of unsystematic price risk. So the systematic price risk implies that movement of the asset prices in either direction leads to corresponding effect on the portfolio value, and if the effect is unequal, then that is unsymmetrical risk. Then we have absolute and relative risk. So absolute risk is calculated with reference to initial investment. For example, if the initial investment of rupees 100 declined to rupees 90, then due to fall in prices, then the absolute negative return is 10%. Relative risk, on the other hand, is calculated with reference to the benchmark, such as stock index. So if the index during the same period, when you have an initial investment, declined, for example, by 5%, then the relative return is worse than the return on the index. And then it will be called as relative risk. Then we have directional and non-directional risk. So directional risk then is the risk which involves the movement or the exposure to the direction of a financial variable. So linear measures such as beta for equity shares, duration for fixed income securities, and delta for derivative securities are used to measure directional risk. The certain measure of non-directional risk include volatility for equity shares, convexity for fixed income securities, and gamma for derivative securities. Now we come to the currency risk. Risk is the risk of foreign currency rate fluctuation, and banks are highly exposed to forex risk because they are the major players. From a corporate standpoint of view, foreign exchange risk may be divided or classified into three categories, which is transactional exposure, translation exposure, and economic exposure. Wherein transaction exposure is due to the change in exchange rate between the date of transaction and the date of cash outflow and inflow. That is, the settlement date of the transaction. The translation exposure occurs on the consolidation of financial statements. When the consolidation of subsidiaries are done with the holding companies, and when we convert the functional currency into the reporting currency, that leads to give a translation exposure. Then we have economic exposure. So economic exposure is also called as operating exposure, and it is caused by the effect of unexpected currency fluctuation on company's future cash flow, or you can say market value. It is long-term in nature and threat to the core business model when there is a competition in the imported product in the market. So for example, I help you to understand, the economic exposure. Then we can say, for example, a US company that gets 50% of its revenue from overseas markets forecast that there will be a gradual decline in the US dollar against the major global currencies for the next 2 years and leads to have more profit. And if the US dollar appreciates instead of declining gradually in the next 2 years, then this would represent economic exposure, because the dollar strength means that the revenue and the cash flow to the company received from the overseas will be lower or the less when converted back to the dollars, and thereby lead to decrease in profitability and its valuation. So this is economic exposure. Then we have interest rate exposure, or the interest rate risk. It is the risk which is the potential loss from the unexpected changes in the interest rate, which can significantly alter a bank profitability and the market value of equity. So if the interest rate rise, the cost of fund increase more rapidly from the yield on assets, thereby reduce net income. Then commodity risk is the risk which arises from the potential movement in the value of commodity contracts, which includes agriculture products, precious metals, energy products, etc. Now moving to the liquidity risk. So liquidity risk is an important source of financial risk. It consists of two types of risk: funding liquidity risk and the asset liquidity risk, which we will surely cover in detail when we do the liquidity risk management. Then we have credit risk. Credit risk is also known as default risk, and the risk that the other party is unable to fulfill its contract obligation or loss arises due to the less of, due to the credit worthiness or decrease in the credit worthiness of the borrower. So losses due to the credit risk can occur before the actual default due to changes in the credit rating of the counterparty. Then we have operational risk. So operational risk is the risk arising out of the failed internal processes, people, or the system, or from external events, wherein if we talk about the external event or external risk factors, which includes political, legal, regulatory factors, natural disaster, theft, and terrorist activity. Now, I believe you all have understood in detail that what are the different types of risk. Now moving to how we can do the management of risk now. So risk management and its benefits. The forecasting and evaluation of financial risk together with the identification of procedures to avoid or minimize their impact. So risk management is when the financial manager's target is to avoid or minimize the risk by forecasting and evaluating the risk, wherein they provide a procedure. So what are the benefits of risk management? As we all know that the goal of modern corporation or the companies is to maximize the shareholder wealth, and risk has to be managed effectively while ensuring achievements of the desired return. So risk management does not, however, imply avoidance of risk, because I must tell you that playing safe is the riskiest choice we can ever make. And that's why when we talk about business risk or the inherited risk, then we say that risk is going to be there. So taking reasonable and well understood risk is necessary to earn good returns. A firm or a corporate must therefore establish sound policies and procedures to identify, measure, monitor, and control risk. So the risk management leads to certain benefits, like it enables quantification of risk, helps identify extremely risky situations, improve risk awareness, enable performance measurement on risk-adjusted basis, reduce earning fluctuations, or we can say reduce earning volatility, maximize shareholders' value, and leads to promote jobs and give financial security. Now, so what are the steps in risk management process? After knowing the benefits of risk management, so what are the effective steps which we need to take so that we can do the risk management properly? So there are 3 steps process of risk management, in which the first is risk identification. And this first step is the process of risk management, in which the identification of potential losses is done for all type of risk. And how we collect the source of information in this case. So the risk managers can be asked to fill questionnaires aimed at identifying various loss exposures, and risk exposure checklists can be prepared by different segments of the firm. Insurance policy checklists are also available, which offers insurance cover for different types of risk, and these checklists can be referred in order to identify the risk facing by the firm. Advice of experts in the field of risk management can also be obtained, because after learning all this and after gaining the certificate of risk management, you all gonna be risk advisors or the experts. Then physical inspection of the firm facilities can be carried out to identify the major loss exposures. Historical data can also be, the source of calculating or identifying the risk. Then financial statement also provides information about the assets and the sources of income that require protection. So thereby, we can do further analysis and interpretation of financial statements. The next step is evaluating potential losses. So when we need to do the risk evaluation, so it means that the various types of risks can be evaluated by using various different techniques and models, and thereby we can reduce the severity of loss. Credit risk is evaluated on the basis of amount of credit exposure, that is, the likelihood of the default of the credit standing and the recoveries under default. Market risk is captured through the VAR, which is value at risk technique, volatility measures, and different sensitivity measures such as beta, duration, delta, and so on. Evaluation of operation risk involves estimation of potential frequency and severity of losses. So after evaluation of risk, the important and the most important step is risk handling, which means selecting the appropriate technique for treating loss exposures. So the techniques available for handling loss exposure includes avoidance of risk, loss control, retention, non-insurance transfer, and insurance. So let's understand this risk handling techniques in detail. So when we say risk avoidance means avoiding the risk altogether. For instance, a firm can avoid the risk of loss arising out of customer default by deciding not to sell on credit and to sell on cash, which is not practically possible. So, one has to decide what risks are reasonable to assume. Then we have loss control. The loss control involves activities designed to reduce the frequency and severity of losses. Two major components of loss control are loss prevention and loss reduction. The loss prevention is aimed at reducing the frequency of losses. For example, loss by theft may be prevented by having adequate security arrangements, and similarly, bad debt losses may be prevented by using strict credit appraisal. The purpose of loss reduction, on the other hand, is to reduce the severity of loss after it occurs. For instance, loss from bad debt can be reduced by not allowing further credit to the similar customers. Now we have risk retention. So risk retention, when the firm retain all or the part of the given risk. So risk retention is advisable when losses are highly predictable. For instance, a firm may decide not to take an insurance policy for losses which is arising out of the petty thefts by employees and shoplifting by customers. Coming to the non-insurable transfer. In non-insurable transfer, the risks are transferred to a party other than an insurance company. Using contractual clause, for instance, entering into a fixed price contract with a building contractor to transfer the cost escalation risk, factoring, which is transferring of your debtors to a third party, and hedging transaction using derivative security to offset risk arising out of fluctuation in the prices of underlying securities. All these are non-insurance transfers. Then we have insurance. Insurance is the most practical method of handling risk in most of the cases. And insurance is advisable for risks such as fire and explosion, where the frequency of risk is low, but the severity of risk is high. And we can also say that when a firm uses insurance, it has to decide on the insurance coverage and has to select the insurer. Insurance has many advantages. It indemnifies the insured after a loss occurs. It also reduces the uncertainty faced by the insured. And the insured also get access to valuable risk management service provided by the insurance company. On the other hand, insurance is costly. So a firm has to spend considerable time and effort in negotiating with insurance companies, and also insurance leads to a lax attitude by firms towards loss control. So now we have understood that what are different types of risks are there, what are the sources and the factors of risk. Then we have understood that how the risk management can be done and what are the different risk handling techniques. Now let's do the recap. So risk is the adverse deviation in actual outcome. Risk arises from economic, market, technological, and financial factors. Then we learned that there are two types of risk, business risk and non-business risk. Business risk assumed as a part of business itself, and the non-business risk includes strategic and financial risk. Wherein financial risk includes market risk, credit risk, liquidity risk, and operational risk. And in the end, we have learned that risk management involves risk identification, risk evaluation, and risk handling. And what are the different risk handling techniques? I know, and I'm sure that this session proves to be very fruitful to all of you. So, keep learning. Thank you very much, everyone. And let's have Q&A session now.